Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. We'll start in China, where over the weekend, the People's Bank of China vowed to step up financial support. Much of the focus is on two areas, tech innovation and consumption. And to that end, the PBOC reiterated a pledge to lower interest rates as well as the reserve requirement ratio. For a closer look now, we're joined by Willem Sels. He is the CIO, right? He is the global CIO at HSBC Global Private Bank and Wealth, joining us from our studios in Hong Kong. Willem, thank you so much for being with us. I think the message here of stronger stimulus is going to remain a key focus for anyone who wants to put money to work in China, be it a retail investor domestically or, let's say, an institutional investor offshore. Have you heard enough from the government? Has there been enough stimulus applied so far to make you a buyer of risk assets in China?
So we have a neutral allocation to Chinese equities. That is because we indeed are waiting for that stimulus to come, and I believe that the market and our clients want to see quite a significant package in a one-stop, one go, rather than incremental measures. But the government has announced a lot of things already. We do expect them as well to lower the interest rates, to lower the reserve requirements. Clearly on the fiscal side, there will be stimulus as well. You mentioned that the stimulus would be on the technology side and on the consumer side. I do indeed think that for markets it would be very encouraging if there is a lot of support for domestic demand, because clearly the uncertainty is around exports, especially with the new U.S. administration. So therefore support for domestic demand for the consumer in particular through trade-in schemes and so on would be a positive. But we are waiting for those measures potentially until March. Obviously, when you get the big parliamentary NPC meeting, that could be the time that we get that package. And if that is convincing, then we would indeed increase, because obviously Chinese equities are very cheap.
So, Willem, I'm curious about what the catalyst may be to inspire some buying in Chinese markets. I mean, if it's not an issue of valuation, what is the trigger? What are we waiting for?
So it is the size of that package, and indeed that would, in my mind, first bring in the local investors and the regional investors, and then ultimately the foreign buyers. I think the foreign buyers potentially have less FOMO, and will want to see the proof in the pudding, will want to see those earnings accelerate, will want to see the more positive economic data. But obviously, even though the foreign buyers are a little bit more reluctant, they also have the very, very low position. Many of them have zero. So, I do think that if the stimulus is convincing, that you have a market that could rally a lot. For now, for us, we are awaiting it. And therefore, that's why we have that neutral allocation.
15 days until the Trump administration. Talk to me a little bit about the risk that you see in U.S.-China relations as it overhangs the macro in China.
So I do think that what people are most looking at is obviously the tariffs, but from a global perspective, that mainly impacts the markets through the inflation and through the interest rate channel, right? So if you have tariffs that are widespread, so that's still a question mark, because it could be that they are just a negotiating tactic, but if they are widespread, then what is the impact on interest rates? The Fed members have already tried. Some Fed members have already tried to incorporate that. Others have not. So it's clear that there is big uncertainty around this, and therefore I think the rate market will, be volatile as further announcements are made, and potentially those negotiations mean that interest rates go up and down. So I think the bond market is going to be volatile. That creates opportunities as well for active managers, obviously, right? Who can lengthen, shorten duration, or go up, down the credit curve. But it is also that bond market that is the most significant threat to the equity market. I think equities are still the place to be because of a decent economy. But the bond market will create volatility in equities.
So I'm curious, if you move away from China, where are you finding opportunities across the Asia Pacific?
So, Asia indeed, as you are implying, I think, is a very diverse opportunity set. If you look at China versus India versus Japan, they are very different countries, very different markets. And so we have overweights on both India and Japan, and by the way, also on Singapore. Japan, there we are going to have, further wage growth. We're also going to have potentially some fiscal spending ahead of the upper house elections. That wage growth gives obviously consumers more to spend, leads to growth, but also a little bit of inflation is not bad for companies because it gives them pricing power. I don't think inflation is so rampant that the Bank of Japan needs to hike very quickly. I think you get 2 interest rate hikes. So Japan is still a market that we stick with. And then India, I would say, for people not to get too worried about the recent weakness in the cyclical data that was mainly urban and high tech. I think there is more stimulus now for the rural side, for the mid-tech side, and then you get the formal employment, which is being pushed as well. It's a market that I think people need to stick with. Because from a structural perspective, this is a very attractive allocation.
So if you look at the themes here, I'm wondering if there is commonality in Japan and India and whether the play is on the consumption side, on the consumer. Is that logical?
It's basically around Asia. We focus on the domestic side and on the consumer side, indeed, as you were saying. So I would even lump in China on that as well. Where we do think that ultimately you are going to get that boost to consumer power. Clearly, that also then means that a trade like that makes you less sensitive to whatever happens on the trade side.
I have to ask about South Korea. Right now I'm seeing a rally in the equity market in Seoul. How do you view political risk as a factor in putting money to work in the South Korean market?
Yeah, I mean, that is obviously difficult to assess as to what is going to happen there. Immediately, I do think that our clients tend to want to try to allocate on an fundamental basis. And there, what you're seeing sequentially year over year is you saw quite significant growth in earnings as tech rebounded last year in terms of earnings growth, and then this year that is slowing down a little bit. It is a quite concentrated market, and that's why we have a neutral allocation on South Korea for the moment.
You mentioned Singapore a short while ago. What's the thesis?
The thesis is it's a relatively defensive market, but nevertheless, it's been the top performing market in ASEAN. It obviously also has an income element which is quite significant, and then exposure to the banking sector, which is doing quite well. So that's why we have an overweight in Singapore. Around the world, we really try to diversify. So the fact that we're overweight to UK, for example, is not that we're super excited about it, but that clients cannot just have that overweight in the US, and obviously markets that have low valuations plus a defensive element plus a different sector composition than the US. They can benefit from having an overweight. So that's how we come up with diversify in the UK, Japan, India, and Singapore.
One of the things that I want to address before I let you go is the dollar. The Fed increasingly has been sounding a little bit more hawkish. A number of officials here in the States over the weekend indicating that the fight against inflation is not over. There's a little bit more to do in terms of reaching that 2% target. If we can agree that there are fewer rate cuts that we're going to get from the Fed in the year ahead and that the dollar will remain resilient, does that create a bit of a pall for risk assets in your neck of the woods?
So we completely agree that you have fewer rate cuts than previously thought, and in particular, obviously, you need to compare that to what other central banks are doing. So, for example, the Eurozone, where you're going to get more cuts than in the US. So that leads to a strong dollar. That is not a positive for emerging markets, obviously. Higher for longer rates and stronger for longer US dollar. And so therefore, you've seen quite significant outflows out of emerging markets. But I do think that this has to do as well with a number of idiosyncratic events, like, for example, Brazil, where you've had the outflows as well. I think what people are doing to address the strong dollar, is being in areas where that doesn't matter all that much. Number one, the U.S. itself. You could also look at hard assets. So people looking at gold, for example. Although there is that negative correlation with the U.S. dollar, there is also the concern around higher deficits, and that's where gold can help. And then within the emerging markets, oil exporters, for example, obviously tend to be less sensitive to strong dollar.
Willem, we'll leave it there. Thank you so much for being with us this morning. I wish you the best for 2025. Willem Sels is the Global CIO at HSBC Global Private Banking and Wealth, joining us from our studios in Hong Kong here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Stateside this week, the Fed is going to be one of the dominant themes. On Wednesday, we'll get minutes from the last policy meeting, and no fewer than 6 Fed speakers are on the calendar. It was just over the weekend that we heard from 2 Fed officials, both saying the central bank must finish the fight on inflation and get to that 2% target. Joining me now from our studios here in New York is Hilary Kramer. She is the Chief Investment Officer at Kramer Capital Research. Happy New Year. Thanks for stopping in. So the December meeting from the Fed, we got this idea that there are going to be fewer rate cuts in the new year, right?
Yes, that was the message.
From 4 down to 2. And I'm wondering whether you think maybe there's still too much optimism that we're going to get those 2 rate cuts.
Well, the factors determining that, much of it, if we want to talk inflation, right? Now, yes, the Fed is not as stuck on this exact 2% level, but let's talk tariffs and the fact that no matter how you slice it, a tariff is, even if it's beneficial, I'm not making a comment on tariffs itself.
On the policy side.
It creates a tax on the consumer. It creates a tax, meaning inflation occurs when you have tariffs.
But didn't the Fed seem to suggest that a number of members on the committee were a little concerned about the inflationary impact of some of these economic policies from the incoming administration?
The Fed members are concerned, and this brings up the second point. And this is not about numbers, policy, but this is about politics. And I'm talking about the politics of the Fed. The problem is how much pressure is the White House, is the President Trump administration from the White House, from the Oval Office, going to put on the Federal Reserve? Mm-hmm. Okay. Now, we know that our chairman has said, hey, I am finishing my term.
Right.
I am finishing it. And he said that emphatically. But at the same time, there's going to be pressure to cut rates because President Trump wants the market to keep going up. But we just had a 24% S&P 500 in 24, a 25% S&P 500 in 2023, meaning upwards. And that's 3 times what it ordinarily would be, meaning even just to go back to equilibrium, we would have to have a down year in 2025 for the S&P 500.
So one of the negatives potentially on the economic policies from the new administration would be that they are inflationary. But if you look at some of the other things that are being suggested, a lot less in the way of regulation. Isn't that a market positive?
Regulation is a positive to some extent, but if at the same time, we don't want to eat our young, so to speak.
We don't want the Wild West again.
Okay, and that's part of the problem here, and this whole sort of go down to Mar-a-Lago and pay your fee for entrance, so to speak, for the inaugural balls. In the form of millions of dollars, everyone's trying to curry favor, and when you have too much of that going on, it will be a problem.
But I'm thinking of the banks. Aren't they a beneficiary?
Oh, the banks. Oh, okay. Financial institutions, which is one of the topics that I am most bullish on. I see the financial institutions. I mean, it's going to be their year. November, December, there were investment bankers because I sit on boards, and I can tell you, investment bankers, you call investment banker, they called back in 1 second and were willing to take transactions or, fairness opinions for so much less money than they ordinarily would because there's been no business. There is so much in the pipeline. And the venture capital firms, they have a lot of IPOs in the market, but then you also have all these bankruptcies. And that's why, like, if someone said, let's say you said, Hilary, where is there real opportunity in financial institutions? I would say in these boutique investment banks that are not dependent on consumer credit the way that you have at a Citibank.
Right.
So I'm talking Evercore, Lazard. I especially love Moelis.
So when you look at deal flow, is there a theme here that we want to tease out a little bit?
The theme is going to be, you're going to have the Goldman Sachs's doing these massive transactions where we're going to have cross-border mergers with big fees. And one might say that it might be built in to some extent into the stock price, but so few people realize the extent at which money can be made, not just on the advisory fee, but on the financing, on investing the money of the principals who just cashed in and got $20 billion. I mean, they make money every which way. So the big financial institutions will make money. And then the boutiques are going to make money as well because there's a lot of deal flow that needs to be handled, especially, let's say, in retail, big box.
Right.
Look, this has not been a great year. Just take a look at companies like Big Lots.
I'm also thinking crypto is going to be a big factor here. Am I right about that?
Oh, crypto. So this is why I am bullish on Coinbase and I'm bullish on Robinhood, but especially on Coinbase because Coinbase is your one-stop shopping for digital currency. They handle everything, including this tokenizations, meaning you have companies, nonprofit people that are tokenizing. They're creating these tokens, and many of them will go down, but it's who's doing the transaction, who gets the transaction fee. As well, with, let's say, Robinhood, for example, it is so easy to open an account at Robinhood as an individual and do fractional ownership of digital currency, of the Bitcoins, Ethereums, the Dogecoin, all of them, as well as, but it's the leverage, the margin that people can take. Now, the individual has to be very careful and tread with incredible care when it comes to investing in the Bitcoins, right? Bitcoin is not gold, and it is going to have a place in our economy, and it will because the White House is going to dictate that Bitcoin is to be bought. And so therefore, the price is going to rise. And you have countries that are buying in Bitcoin. And when you have tariffs, what's the way around tariffs?
Right.
You deal with Bitcoin and purchases, and you bring things in through the port. So Bitcoin is going to have a value. So we should expect to see that going from the mid 90,000s to 150,000. I mean, easily 150,000 to $200,000. But then one day it's musical chairs and it comes down.
Well, let me talk about a little bit about what may be vulnerability. It was a great year for the equity market. It was also a great year for the crypto space. Are markets right now vulnerable in your view?
Very vulnerable. Very vulnerable.
And what are you doing believing that?
I am recommending that everyone keep their powder dry.
What is that, 20%?
20% to 30% in cash. And wait, especially because you might not be able to get 5%, but you can still get 4% and lock it in, or 3.75% on your cash. That's a pretty decent return, whether you're an institution or an individual. And you can wait because it's too risky to be jumping in at these levels. We are at levels of 1999, 2000, when the internet was at its height. This reminds me of Yahoo being $250 a share, dropping to $170 a share, people going in and buying millions and millions of dollars of it, and then the next stop was $20 a share, and margin calls.
So we've been talking a lot about deals here that may be attractive in the United States on the equity side, maybe in the crypto space. We've talked a little bit about some of the themes that may be driving the price action. Are you seeing anything away from the U.S. that is curious to you right now that may be piquing your interest? Offshore, anything?
Yes, the big pharma companies, especially Sanofi, SNY, they really have such an incredible pipeline. They missed the COVID-19 vaccines and the therapeutics, but they have put so much money, this French biotech.
Yeah.
Now you also have Novo Nordisk, which did have a hiccup, a very rare hiccup in November because they had an obesity drug that didn't have the most positive returns that they thought it would have in one of their phase studies. But Novo Nordisk, look, we're going to be, if there are so many people on Ozempic and Mounjaro right now to lose weight, but we haven't even started to see how many are going to be on that now. We might see some bounce back with the car companies in Europe that have done so poorly. They've really struggled. We could see that just simply because they're oversold, and then even like look at Toyota. Look at a Honda-Nissan merger, what that might end up creating. So there's opportunities to jump in now.
We'll leave it there. We've covered a lot of ground. Thank you for coming in, sharing your thoughts with us. I wish you the best for 2025. She is Hilary Kramer, Chief Investment Officer at Kramer Capital Research, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.